The Fed's going to meet tomorrow on Wednesday, and they are going to have to decide what to do about rates. We're going to talk about that because that's what's happening today in mortgages. Hey everybody, welcome back to Today in Mortgages. My name today is The Rock, and I have with me Rich Jefferson, aka A Hard Place. And what's happening tomorrow is going to be a conversation between a rock and a hard place, and that's what we're having today on today's episode. Hey, Hard Place, how you doing?
Hey man, we're doing good, doing better than the Fed chair.
That's right. I called myself The Rock because I've been hitting the gym, trying to bulk up a little bit for swim season coming up here in Houston. Man, I tell you what, in Houston, we had spring break last week. And at the beginning of the week, I was in the swimming pool. And at the end of the week, we were getting our winter clothes back out of storage. So we had all the weather and things are going crazy in the economy as well. And so we're going to talk about that today. And today I have an article from U.S. News talking about all the turmoil. And it's called Fed's Tough Challenge, Confront Inflation and Bank Jitters. So, Rich, without getting into what we think is going to happen, let's talk first about really just all the factors that are at play that have to be considered tomorrow. So coming into a couple of weeks ago, it was pretty clear that inflation was still higher. We still had higher jobs numbers than we probably wanted to have, which is good for jobs, bad for inflation. And so at that point, what was the Fed thinking?
They got to keep raising rates. They've got a mission. They want 2% inflation.
Yeah. So inflation numbers also came back. We'll get there in a second. And then a couple of weeks ago, as we talked about here on the show, Rich, what happened in the banking sector?
Well, there was a run on a few banks. Banking is tough right now. Now, keep in mind, if something spooks something, so somebody learns something about some bad investments, there could be a quick run on a bank. And all it takes is a bank to, have a 30 or 40% of their depositors withdraw, they're done, because then they have to go sell assets in order to accommodate that withdrawal.
And we talked about why Silicon Valley Bank and Signature Bank are different than probably your local mom and pop bank or even, Chase or someone else that you're banking with. And so that worry probably shouldn't spread across the economy. But of course, people get spooked, and that does happen. And then also, to make matters worse, over this past weekend, Credit Suisse also had some trouble in the European market. That happened because that bank had some bad governance as well. And so again, different than your local mom and pop banks, this is not an epidemic, but it is happening because of what's happening with rates and what's happening in the economy. So something you should be paying attention to, but something you probably shouldn't be worried about too much. But it will play into the Fed's decision tomorrow. And when we talk about the Fed, they typically have two big jobs: to keep inflation low, that goal of 2% that Rich was talking about, and to keep employment high. And we've had really high employment, but those goals push and pull on each other. And if you have high employment, it's going to raise wages, and that's going to push up inflation. And that's what we've been seeing. And so they're trying to balance those two out. But another one of the Fed's jobs that we don't talk about too often is keeping banks in play. And so when Signature Bank and Silicon Valley Bank collapsed a couple of weeks ago, the Fed had to step in a big way, ensure some extra money that they don't typically do, to try to quell the fears of what's happening in the banking sector overall. And so going into the Fed meeting tomorrow, Rich, we have a lot going on. And so where do you think Jerome Powell's head is at right now?
The article, it spells it out pretty accurately. I mean, he's in a very tough position. The entire Fed is in a tough position because they're there to fight inflation. Inflation doesn't seem to be weaning. It's still chucking along, and we got a lot of work to do there. But if you raise interest rates, you almost perpetuate the problem with the banks. But this is no 2008 financial crash. This is completely different. So that's not the problem here. The problem is we're trying to fight inflation. The only way to do that, or one of the Fed's main tools, is to raise rates, which raises rates on mortgages, car loans, credit cards, a lot of business loans. So that then will slow growth. It's tough, but if they don't do anything, then that shows that they're really scared about the bank situation.
Yeah, it's definitely a tough situation, Rich, and you want them to portray confidence. And Rich, you did mention inflation earlier. That report came back last week. I think we're at 6%. Can you talk about, how that's playing into the decision for tomorrow?
They're looking in the rearview mirror and making decisions based on what they've seen. So here we go. I don't know. I don't know where this goes. All I do know is that it's still too hot.
Oh, it is a tough place. And I have a quote here from the article. And you're talking about what happens if the Fed leaves rates alone. It says, if the Fed were instead to leave rates alone, which some analysts last week had suggested it might do, given the banking turmoil, it could alarm Wall Street traders by suggesting that significant problems remain in the banking system. It's a lose-lose situation there. So if they don't raise rates, people are going to think, oh, they are really worried about the banks, and we should be worried about my bank too. If they don't raise rates, they're also going to alarm traders. If they do raise rates, we're going to see some stuff happening in mortgages. And so, man, it is truly a rock and a hard place right now. But I still feel like there's a lot of hope out there, even though there's so much jitters in the market. What do you feel about the market right now?
Well, it's a grind, definitely. Yeah. But what makes it tough is it's just so volatile right now. Just as a mortgage advisor, you're trying to advise your clients the best time to lock, the best products. And when rates are jumping up and down on a daily basis, and I'm talking wide ranges, that puts, it could hurt our credibility because I always advise to lock. I just don't watch the news, lock, you're comfortable with a payment. If rates come down in the next, 12 to 18 months, we're going to refi you. But don't sit, because they could easily go down, but they're more likely to go up right now. So find the home, find the payment that fits with the right loan product, and move on it. You don't need to be bold and brave right now. Real estate has forever been the best investment for middle-class America. That's it. So go get it.
Yeah, and I think that's a good point that you hit on there, Rich, to be able to talk to your buyers about this and also to focus on their situation and help them see perspective on where they are actually financially and what they can do to get into that house.
We have to start reminding renters, okay, so property, let's say it drops 5%. Right now, you're spending $24,000 a year on rent. That's like losing $24,000 a year right now. That's well more than 5% in value on a property. So we just got to reframe it.
Rich, I do have one more quote I want to talk about here. But before we do that, I'm going to take a quick break and tell everyone out there about a free resource that we've put together right now, because the market is tough, like we talked about, but you can be doing things right now to help you win. So we think that is marketing yourself well. And so we put together 5 tips for you to get ahead while the market is down. And you can pick up that free resource at todayinmortgages.com/marketing. Again, that's todayinmortgages.com/marketing. Go check out that free resource, download it, and start taking action today. Reach out to us if you have any questions about it. Hey, Rich, I have one more quote I want to talk about. Another piece of kind of silver lining here is there's a quote from the article that says the potential slowdown in lending is going to do some of the Fed's work for it. And we're talking about lending in general, not just for homes. And that's a quote from John Roberts, former Fed Reserve economist. It goes on to say, so the Fed won't have to raise rates as high as otherwise. So some of the slowdown in banking, slowdown in lending might actually result in us stopping some of those rate hikes in the future a little bit earlier than we thought. Again, no crystal ball here, just reporting what the article said. We don't know what's going to happen, but that is a silver lining that we could look for. So, Rich, this article, I think it was pretty factual. I think we know where we stand on this, but I'm going to let you rate it anyways. How do you feel about it?
Yeah, it's 5. I mean, yeah, I don't like it, but it's still accurate. It's good information, and the Fed's in a tough spot.
Yeah. So we will be paying attention tomorrow to that Fed meeting, and we will be talking about that probably on Thursday. So stay tuned. Thank you guys so much for joining us. If you liked what you heard today, like, subscribe, and share this episode. We'd love to get out there to more listeners, and we'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.